So yesterday, the markets once again slowed down following the 2-week-long-ish rally as investor fears from the war in Ukraine, the Fed's tightening and inflation just sort of drifted away almost overnight. Bond yields fell once more and we saw another big yield curve inversion, and the big fear right now is shifting to the impending recession that markets are starting to price in, all of which and more we will cover in today's market recap, so let's get right into it. So what actually happened with the markets? Well, the S&P 500 rose by 0.3%. It was a pretty steady day, no major gains or losses at all, and it was pretty uneventful. The Nasdaq rose by 0.2% and saw the exact same story, quite a tame day for US equities then. In Europe, again, it was similar, with the Stoxx 600 rising by 0.5% and the FTSE 100 rising by 0.3%. Has sanity finally been restored to the markets? Well, probably not. This was just one day that wasn't volatile after actually quite a volatile week. We are now at the end of the week though, so what is the situation for how that week performed? Well, we saw major gains followed by some major losses, which means that on the whole, we saw very small improvements across the board. The S&P finished pretty much exactly where it started. The FTSE, the Stoxx 600 and the Nasdaq all rose, but by under 0.5% for the week as a whole. Now, in particular for yesterday, we had the US jobs report came out, which was close to what was expected, but a very small miss. Still a relatively strong report though. What are the specifics then? Well, the US economy added 400,000 individual jobs last month, slightly less than expected, but again, not by a large margin. Leisure and hospitality added 110,000 jobs, restaurants added 60,000 jobs. This industry though, as a whole, the service-based industry, is still 1.5 million jobs below where it was prior to the pandemic. Now, unemployment fell slightly and it now sits at 3.6%, down from 3.8%. The labour force participation rate rose by a very small 0.1%. In general, there was no specific bad news here, but nothing crazy positive either. The big problem with this is that from the market's point of view, this will influence what the Fed will do in the future. For a year now, the Fed has pretty much refused to tackle inflation under the guise of protecting the economy and specifically the job market. But now with employment so high and unemployment so low and inflation so damn high as well, the Fed is running out of excuses not to raise interest rates in a really strict manner and start quantitative tightening. Now, the markets, they hear this positive jobs report and two things go through investors' heads. Firstly, they think that this is good news for the underlying economy. People working is good. But then that's bad news for the economy in the future, as it means the Fed might start hiking interest rates by 0.5% intervals every month. The big problem with this is that unemployment is a lagging indicator, which means it doesn't predict recessions at all. It drops after recessions start, and the risks of recession are growing really large amounts right now. There is a very good chance that the Fed hikes rates into a recession, making it worse, before turning around and turning the money printers back on, leaving us in an even worse position than we're in right now, with inflation high and the economy in the ditch. Now, all of these problems are the Fed's fault though. It's due to their negligence over the last 2 years that we're in this position, and we need them to do their job properly and actually target a price stability mandate to fix the problems that they've created. But in my opinion, as you all know, the Fed is full of morally bankrupt people and corrupt officials, so that's unlikely to happen. Anyway, that is the general idea behind this jobs report and why, despite it actually being quite a good report, the markets aren't necessarily loving it. Now, we saw another slight increase in bond yields as prices fell again, with the US 10-year Treasury now sitting at 2.38% yield. The really big news is, of course, again regarding the yield curve inverting. Now, earlier in the week, we saw the 10-year and 2-year curve invert, which is basically a sign that investors expect a recession because they're pricing in higher interest rates in the short term, but lower interest rates in the long term. So they're basically expecting a recession to come as the Fed tightens their policy. And then as the economy starts to decline and we enter a recession, they will expect the Fed to then drop interest rates back down to zero. Now, the yield curve inverted only for a moment the other day, but it's been trending in that same direction for some time now, and really it's just been inevitable. Anyway, yesterday we saw it invert again, and within a couple of weeks it will probably remain inverted pretty much for the foreseeable future. The 1-year forward estimate of the 2- and 10-year bond spread is now 0.4%, which basically means in 1 year's time we are expecting the curve to remain inverted by 0.4% permanently. Now, we've only seen the 1-year forward estimate of this spread being this low at the dot-com crash. During the 2008 financial crisis, it mostly hovered around zero and didn't go this negative. And then yesterday as well, we saw the 2-year and the 30-year Treasury yield curve invert as well. A major signal that the bond markets are pricing in a recession. We haven't seen this specific inversion since 2007, just as the global financial crisis was kicking off. Now, as with this sort of stuff, there are always loads of different indicators that we try to use to gauge where the economy is going, and none of them are perfect. Some people specifically are claiming that we should only be looking at the 3-month to 10-year yield curve, as that is a predictor of recession in a much shorter time frame. But as I just said, none of these indicators are perfect, and I think the people latching onto that specific yield curve are doing so because it supports their point of view that the markets are fine and will remain fine, when in my opinion that yield curve is different purely because the bond markets aren't pricing a recession in to come in within the next quarter or so, but most likely around the start of 2023 or maybe even a little bit later. Now, that being said, we are of course all entitled to our opinions. From what I see though, things are not looking bright and the markets are finally catching on. Now, as for oil prices, we saw another drop, which is really nice to see, and WTI crude oil has finally fallen below $100 a barrel. It's really sitting at $99.8 a barrel, so not a huge margin below, but at least it isn't as high as it was. Brent crude oil, as always, is slightly higher, sitting at $105 a barrel, so that's a little bit less nice to see. Now, this is about a 1% or so drop from yesterday, basically as traders and speculators try to gauge how impactful the release of oil from strategic reserves will be. It's worth noting here as well that Biden is releasing 1 million barrels a day from their strategic reserve for 180 days in a row, and at current rates, the US produces about 11 million barrels a day, so this is like increasing their production by just under 10%. The important thing here though is the time frame. In about 180 days, we on this channel will probably be talking about the midterm elections, for example, which are in November. Biden's approval ratings are really poor right now because of inflation and the energy crisis, so it appears as though the administration is sort of throwing a Hail Mary, trying to just stave off any more major problems from popping up or developing until they can get through those elections. And then I strongly suspect everything will start to fall apart very rapidly. We also know that the Fed is monumentally influenced by the current administration, even if it shouldn't be, so there's a good chance the president tries to influence their actions as well to suit his aims. I wouldn't be surprised if we see another 7 months of the Fed doing the bare minimum to maintain asset prices and stop the markets from crashing, while slowly letting inflation rise out of control, only to let loose when the elections are done and destroy everything with the monetary tightening that should have happened 6 months ago at the least. I know that may sound quite cynical, but it is something to think about and be a little bit wary of for sure. Now, gold prices didn't really see much movement yesterday. It fell just over 1%, but it's still sitting at about $1,900 an ounce, as it has been for over a month now. And finally, in the world of crypto, what's going on over there? Well, we saw a small recovery by the market after that dip the day before. Bitcoin and Ethereum are sitting at about $46,000 and $3,500 each, up a few percent. Altcoins performed comparatively a little bit better, moving something like 5 to 10% up for the day. Again, there was no singular piece of news to explain this, mostly just pricing pressure at play. The EU news from yesterday that was a bit of a misnomer seems to now be priced as such, as people realise that the EU just can't do what they want to do. If you want to hear more about that, then check out yesterday's video. If you enjoyed this video, then make sure to like and comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thanks for watching, stay stoic, until next time.